Last episode, we learned Micha's core method. Buy a good business below its intrinsic value, then wait for the chart to confirm the turn. It is powerful, but it raises a flood of practical questions. So this episode is pure answers, the secrets, and the most common questions viewers ask about actually using the method in real life. Let's go through them one by one. First, a quick refresher so the answers land. The method has two gates. Gate 1, value, is the stock cheap relative to what the business is really worth. Gate 2, the chart, is the price confirming, reclaiming its moving averages and starting to turn up. You only buy when a stock passes both cheap and confirming. Keep that picture in mind as we answer your questions. Question 1, and it is the most common of all. What software do you actually use to see these charts and moving averages? The answer is the one we have leaned on throughout this whole technical section, TradingView. It is free to start, it runs in your browser, and with a couple of clicks, you can lay any moving average right on top of any stock. That is the entire toolbox for the technical half of the method. Question 2, which naturally follows. Which moving averages exactly should I put on the chart? Keep it simple. You want the medium and long-term ones that define the real trend, not the fast, twitchy ones. The long-moving averages, like the 150 and the 200, tell you the big picture direction, and watching the price reclaim them is your confirmation that the turn is real. You do not need 10 lines, just 1 or 2 meaningful ones. Question 3, the hard one. How do you actually estimate intrinsic value? The cheap part. This is the craft, and we built the tools for it earlier in the series. You look at the company's earnings and its growth, you check the handful of value parameters we covered, and you can use a fundamental site to pull it all together quickly. But remember, you are not chasing a perfect number. You want a rough estimate and a price comfortably below it, so your margin of safety protects you even if your estimate is a little off. Question 4, the one about patience. How long do I wait for the chart to confirm? And what if it never does? You wait as long as it takes, with no pressure at all. And here is the secret that frees you. If the chart never confirms, you simply never buy that stock, and that is a perfectly good outcome. You did not lose anything. There is no fear of missing out here because there are thousands of stocks, and another setup is always coming. The method's power is in how many bad trades it stops you from making. Question 5, about building the actual portfolio. How many stocks should I hold? And how much do I put in each? You diversify. You never bet the farm on a single name. You spread across several positions, and you size each one so that if you are wrong and your stop is hit, you only lose a small, survivable slice of your account. The valuation method finds the candidates, but same position, sizing, and risk management, which we covered with the stop loss, keep you alive to play the next hand. Now, for a genuine secret, a refinement that sharpens the whole method. Among all your cheap, confirming candidates, give extra weight to the one that is also showing relative strength, meaning it is holding up better than the overall market or starting to outperform it. A stock that is cheap, technically turning, and stronger than the index all at once is a powerful combination. The market itself is quietly voting for it. And the deepest secret of all is almost boring. Discipline. The entire edge of this method evaporates the moment you start cheating on it. The instant you buy something cheap without waiting for the chart, you are catching a falling knife. The instant you chase an exciting chart that is wildly overvalued, you are gambling. The method only works if you demand both gates every single time, with no exceptions, even when you're itching to act. And our familiar honesty to close the loop. Even done perfectly, this method only stacks the odds in your favor. It never removes risk. Your estimate of value can be wrong, the confirmed turn can fail, and some of your best-looking setups will still lose. That is normal, and it is survivable precisely because you size your positions sensibly. And the long-term index investor, of course, skips this entire beautiful, demanding process and simply owns everything. So those are your answers. Use TradingView for the chart, a long-moving average like the 150 to confirm the turn, the value tools we built to estimate intrinsic worth, and endless patience while you wait for both gates to open. Diversify, size your positions, favor relative strength, and above all, never cheat the two gates. That is Micha's valuation method, fully unpacked. I'll see you in the next one, where we move from analysis into the art of actually buying and selling. Until then, keep it simple and demand both gates every time.